Welcome to the Four Wise Monkeys, the best shares and investment advice on the web. Our four monkeys providing the wisdom this week are none other than David Stevenson from the Financial Times, Stephen Barber from Self-Trade, ProShare investor Paul Dolman-Darrell, and the naked trader Robbie Burns. And your host today is Ryan Dean. Welcome to the Four Wise Monkeys, and on today's show we'll be finding out why you should go short on closed retailer next, and why Paul thinks Park Group are worth a look. But before all that, we go to Robbie Burns to find out what he's been buying and selling this week.
Okay, Optos is a company I really like the look of, and I'm in it because I think it might get bid for by one of several companies. What it does is it has fantastic equipment that looks into your eyes, can tell you whether you've got diabetes or any number of diseases. It's got a deal with Walmart in the States, and it's got little posts everywhere there where you can go and have your eyes checked. It's growing very, very fast now in the UK and in Europe. Plenty of upside here, and the great thing about it is it's a potential bid target. I think any number of companies I think would like to buy its technology on the cheap. One to steer clear of is Next. We all know Next, it's the mid-range clothes company, but I can't see this one doing very well this year. As we know, the credit crunch is on. When the credit crunch is on, the first thing people do is don't buy clothes, or else they go down market, so they might be shopping at Primark instead of Next. I can only really see more downside here. It's down a lot already, and there's more downside to come.
Now it's time to find out what's getting the monkeys in the studio excited. Now, Paul, you're up first. What share are you going to be looking at today?
Park Group. They're a company who specialise in Christmas saving, hampers and high street vouchers.
Christmas hampers, Paul. Now, they got quite a lot of negative press a couple of years ago, didn't they?
Yeah, there was a company called Fairpack, which was the biggest competitor to Park. Look, it went bust, and actually Park were doing it right at the time. They'd set the savings aside from the company business and have been tarnished badly by this. But the company's recently had a trading update which is showing their Christmas business beginning to recover. The high street voucher business is doing well. The reality is confidence is returning. The company's on a PE of 6. There's a dividend yield of 7.5%, which makes them an excellent buy, and they've no debt in the company at all.
In some ways, it actually sounds too good to be true. Stephen, do you have a view on Park Group?
Well, it's undeniably cheap, and it's also undeniably pretty good returns. My only real concern with it is that it's quite an illiquid stock, and there's always a danger with this type of listing that it could become a delisted security at some point in the future.
David, Stephen, you've both been looking rather miserable in the last couple of weeks. You're quite bearish at the moment. How does that reflect in your choices for today?
Well, I mean, I think the markets are heading only one way, and that's down over the next 6 months to 9 months. And so I've been buying an awful lot of. I've got a piece of paper because there's so many different numbers. SH32, snappy, eh? And that's a covered warrant that effectively allows you to make money if the markets fall. And the way it works out, it pays out in December of this year if the FTSE is below 6,000. And if you think that the markets are going to go down by 10%, which I do, this will make a 70% profit.
Now, Paul, David and Stephen are obviously quite negative at the moment. Are you agreeing with them?
Yeah, I'm quite negative as well. I have a few of these warrants in my back pocket. Bought them recently. I would, however, be looking to enter these on up days, big up days in the market, maybe 3 or 4 days linked together. And what we've actually seen recently is 3 or 4 down days.
Stephen, you're also looking quite miserable at the moment, quite bearish. What are you looking at this week?
Well, I've been looking at gold, which is a real flight to quality asset class. And we've just seen the gold future, the August future, shoot up 3.5%, mainly on the back of global economic news. So we've seen the inflation across the world, we've seen the Fed hold interest rates, and we've also seen the oil price continue to rise. And gold's historically been seen as a real sort of hedge to all these sort of things, a hedge to the reduction in the purchasing power of money.
Gold sounds interesting, David, but how would I go about accessing it?
Well, the simplest ways of doing it, I think the cheapest way of doing it, the most efficient way of doing it is through tracker funds, ETFs, ETCs, comes a company called ETF Securities, I believe. And they're quite a cheap and effective way of buying access. And you can even buy access that's geared so that it's 2 times either way. So, for instance, if gold went up 10%, you get 20% because it's geared twice.
Paul, final thought from you. Gold, are you interested?
From my point of view, it can take a very long time to get returns from gold, and it's very difficult to guess which direction it's going to go in and how long it will take to get there. Not one for me.
That's it for this week's show. Remember to check out 4wm.co.uk for more banter and discussion from the monkeys. We'll be back next week.